Thank you very much for your time today, Joaquín. We have Joaquín Alexandre-Ruiz, Head of Secondaries at the European Investment Fund, and we will be talking about a topic that's gaining momentum in the last years, which is secondaries, right? Why? Why are secondaries gaining momentum, not only in Europe, but the rest of the world?
Let's say that the secondaries market has evolved massively in the last 15 years. We have to think that we have moved from a market that was about 10 billion in 2009, and last year ended up at basically 160 billion or more. So that's a growth of about 15 to 16 times in 15 years. Why has the market grown so much? Well, there are different reasons. One of the reasons is M&A markets have been depressed in the last couple of years. We have seen a very low point in distributions compared to contributions. So we are pretty much at the same level we were back in 2009 at the end of the global financial crisis. There's clearly been way more capital calls than distributions, and therefore LPs have been actively looking for ways to generate liquidity. And how they've done that? Well, they've done that by basically approaching the secondaries market to shop their portfolio. So that's the LP side consideration. The other side of the coin is the GPs. The GPs, as we have seen last year, about 50% of the market volume has been on GP-led transactions. So transactions led by the fund managers. Be it a single asset deal, moving one company to a continuation fund, a portfolio transaction, a strip sale. I mean, name it, there are different types of these transactions. Why they've been so active? Well, they've been so active on the one hand to continue developing trophy assets, but at the same time to be able to generate liquidity to their LPs. Again, come back to the first point that I made, low point in distributions, and therefore that has motivated a lot of GPs to be very active in the market in 2024. And as we speak, we actually expect an even more dynamic market in 2025, probably about 200 billion in transacted volume compared to the 160 I mentioned before.
In general, what are the main challenges when you are identifying the right deals in secondaries compared to other alternative investments?
So I think it's a combination of factors. To be a successful secondary player, you need to have first market access. So you need to have a network of GPs, you need to have a network of LPs, of investors in funds, and you also need to be, well known in the intermediaries world who, typically intermediate transactions. It's important to highlight that the secondaries market tends to be a market that is heavily intermediated. So that's one aspect. The other aspect is that you need to be good at assessing underlying assets. So in a way, the types of skills that are required to be a good secondary investor are similar skills than those you would seek in a direct investment firm. And we have built at EIF a team that is mainly composed of people with this type of skills, direct investing skills. And at the same time, you need to be a good primary fund investor. You need to be able to assess, to underwrite a GP. Why is a GP a good GP to continue managing the assets on your behalf? At the end of the day, as a secondary investor, even if the assessment is similar to a direct investment, you're not going to be managing the assets. The assets will be managed by that GP that is the manager of the fund. So you need to be able to properly assess why that is the right counterpart to continue managing the assets, be it a GP-led transaction, single asset, multi-asset, or you investing in that fund in year number 5 and still 5, 6, 7 years ahead to continue developing this portfolio. So the combination of these two skills makes it actually quite difficult to find, secondary players when compared at least with the primary market that has, maybe 12,000 or more GPs in the world. I think, or market intelligence tells that there's more or less 200 GPs focused on secondaries worldwide. So there's a big difference between the secondaries players and the primary market.
But the number of secondary funds is also growing, right? Mm-hmm. Like there's more interest as we speak, basically. So what do you think? What will be the point where this market goes to gets to maturity, because this is emerging now. You said, I don't know if you mentioned it here or at some previous conversations that we had. No, it's no longer something that LPs used when they want to, in distress, but it's also a management, portfolio management tool. So when is this going to be something mature enough?
We have to think that market has grown a lot. True, 160 billion, as I said, end of last year. Is this representative of a huge market? I mean, it's a big market, but in the big scheme of things, when compared with private assets, net asset values, it's maybe 1% or 2%. So it's very small still. Probably 2025 again will be 200 million north, 200 billion north. The market should grow much more. And I wouldn't be surprised if in the next 10 years we're 1 trillion. At that point, it will be a big market.
Wonderful. And this is about secondaries in the private equity world, right? But why is it so hard, or what do you think about in secondaries in the venture capital funds, which is also something that's emerging lately?
The secondaries market is mainly a buyout market. 75% of these 160 billion transacted last year are in buyout-related deals, be it, again, LP stake acquisitions, LP-leds or GP-leds. It's a buyout market. The remaining 25% is typically split between venture/growth, infrastructure, real estate, and private credit. More or less, 5 to 6% each. Depends on the year. Sometimes a bit more, it's a bit less, but it's somewhere there. Now, as the market grows, obviously 5% of a 10 billion market is not the same thing as 5% of a 160 billion market. So venture is growing. We are seeing more and more GP-led situations on the venture space, something which maybe 3 to 4 years ago we didn't really see. So there is also, I'd say, a momentum to some extent in this type of deals on the venture segment. Having said that, the preference of investors, so secondary investors and investors in secondary funds still is buyouts.
How hard it is to find good deals in venture compared to private equity buyouts?
I would say it's harder, than buyouts, but it's also harder because there's the complexity of putting the right price. I mean, it's not the same thing, to value a buyout asset where you've got an EBITDA that has been growing consistently over years. The bottom-up assessment, I would like to think that it's easier. I mean, not easy, but it's easier to make than on a venture deal. In a venture deal, at the end of the day, there's always going to be an element of uncertainty of how much is that asset worth. Is a 30, 40, or 50% discount enough? I mean, who knows? And that complexity makes it difficult for secondary buyers to be very active on the venture side. It doesn't mean that there are no specialized secondary players focusing only on venture assets. There are, and from what I know, they've been pretty successful. But the vast majority of players, we're focusing on the buyout segment.
Wonderful. And finally, when it comes to ESG, I remember you mentioned that it's like ESG is actually something that you can assess much better when you do secondaries than when you do primaries, right? Mm-hmm. Why?
I think we need to distinguish between the LP-led transactions and the GP-led. So again, on a GP-led transaction, at least those that we focus on as we speak, we have to think about this situation where you've got a fund and there's this trophy asset, one company that the fund manager wants to continue developing, needs more time, needs more money, and will transfer that to a continuation fund. So you've got one asset that you're going to look at. Even if there was a portfolio of, I would say, of companies that are going to be transferred as part of a continuation fund transaction, eventually you have 3, 4, maybe 5. Haven't really seen more companies, more granularity in a transaction of this nature. So indeed, in this type of deals, it's easier to do more work related to ESG considerations, and I'll get to that in a moment. Now, if you're acquiring a portfolio of, imagine 50 limited partner stakes, there are eventually hundreds of underlying companies. Then it becomes quite difficult. So focusing on the first type of deals, the GP-leds, different than the primaries, you know what you buy, and therefore you can not only make an assessment of how is the GP considering ESG in its investment process, be it sourcing, being due diligence, execution, monitoring, managing the asset, and then the exit. You can also go one step down, which is to basically assess how is the underlying asset, again, similar or the same as in a direct investment. How are ESG considerations taken into account by the business or the businesses, the companies? In my example, that single asset or these 3, 4, or 5 underlying companies. So obviously the assessment is dual. If we compare that with primaries, in primaries, you are basically investing into a blind pool. You agree a strategy with the fund manager, you sign up on the legal documents, and then is the fund manager doing the work, investing in the portfolio for 5 years, and then divesting arguably the next 5, 6, or 7 years, no? So your assessment is going to be focused on the processes that GP has in place to take into account all the ESG considerations. That is the main difference between, again, what can be achieved in a secondary transaction in GP-leds versus a primary fund investment.
Wonderful. Thank you very much.